All right, so this is another section we're going to be talking about now. The first section is an introduction to the stock market. And then in this section, as you can tell, it is the introduction to the bond market. So if you've ever wondered how governments and corporations borrow money or how investors earn steady income through fixed payments, what is a bond? This is where this section will talk about. It's very, very simple. This lesson should be very, very quick. It's just going to go over what is a bond. So what is a bond? At its core, a bond is really just a loan, but instead of a bank lending money to a borrower, you, the investor, are the one lending money. So let's say I need money and you have the money. What we can do is instead of you just giving me money and I pay you back in the future, I can give you a bond. And so you give me the money, you lend me the money, and in return, I give you a bond. And in a certain amount of years, I will pay you back whatever money you gave me. Plus, each year, you're going to collect interest. So it's kind of like a loaning thing, but it's a bond. So there are some important information when it comes to a bond. So the face value, also known as the principal amount, actually, so the principal amount, also known as the face value, which is the amount they'll pay you back when the bond matures. So you have $1,000 bond, then when it matures, they'll pay you back $2,000. A fixed schedule of interest payments, which I just mentioned, is called coupon payments, or just coupon. And these are usually made annually or semi-annually. This is your income for lending them your money. So let's say, for example, if you buy a $1,000 bond with a 5% annual coupon, you will receive $50 in interest each year until the bond matures. Then, at the end of this bond's term, whether that's 1 year or 30 years, you're going to get your original $1,000 back. And then let's say it's a 10-year bond, then you make $500 from interest. So when you first give the person the money, they will give you a bond. Every year you will receive $50, and at the end of the 10 years, you'll receive that $50 interest plus $1,000 from the original amount. And so if you see, you gave $1,000 and then in 10 years you got back 1,500. Maturity is the number of years until the bond ends and your principal is returned. And so then the issuer is the person who you're lending to. Like these could be the US government, Apple, or your local city. So as the issuer, that is the person who's borrowing money. So let's say you are giving me money. I am issuing you this bond. I issue the bond. And yeah, and that's why you just say it's the borrower. So there are key points. When you buy a bond, you're not buying ownership. You're buying a promise. It's a promise that you will get your money back. Sorry. You don't get voting rights. You don't get shares in a company profits like a shareholder does. And instead, you're kind of like a creditor. The company's obligated to pay you an interest regardless of whether they're profitable or not. There's something called credit risk. This is how likely a person or an organization is likely to pay back the bond. So usually the higher the credit risk, it means the higher the risk. And usually higher risk bonds have higher interest because why would I put in my money into a high risk bond that has the same interest as a low risk bond, right? You want to make more money out of the high risk bond, so that's why the interest on that one would be more. So as time goes by, you're making more money from that bond than the low risk bond. It's pretty simple, to be honest. So stocks versus bonds, I kind of mentioned it, but I'm going to explain like the core. So stocks and bonds, this makes bonds fundamentally different from stocks. A stock represents ownership, like we mentioned, and their value can grow exponentially, but they're also volatile and you could lose everything. So stocks go up and down. On the other hand, bonds are debt. They represent debt. They offer more stability. It's a regular income and a clearer path to getting your initial investment back, as long as the issuer doesn't default. So what this is saying is when you're lending money to a bond, you are promised that interest. So no matter what, you will be receiving those payments. Now, when I say as long as the issuer doesn't default, this means defaulting is when that issuer loses all money, they have nothing, they go bankrupt. That's when you have risk. So this is where risk comes in. So your credit risk is how likely is that person or organization or government is likely to default. Now, if you just think about it, we're not really going to talk about this in this lesson, but more of the next lesson. But if you have a small little company that just started, they're going to be the most risky, right? And then as the company gets bigger, the credit risk decreases. On top of that, governments are also very, very low risk. We're going to talk about a risk scale like AA. You'll see. But yeah. And so because of this, bonds are considered lower risk compared to stocks, especially when they're issued by stable governments or highly rated corporations, like I just mentioned. This is why they're often used by investors who want more predictable returns, like retired people or anyone looking to reduce overall portfolio volatility. So how do bonds differ from stocks? So when you invest in a bond, you're acting as the lender, you're loaning your money to a government or company, and in return, they agree to pay you your interest at irregular intervals. These are called coupons, like I said. And at the end of the bond's term, known as the maturity date, like I mentioned, you get your original investment back. This is called the face value or principal. And then with stocks, on the other hand, you're not lending money, you're actually buying ownership in a company. That means you become a shareholder entitled to a portion of the company's profits. And then if they choose to pay dividends as well. And potentially benefiting from an increase in company's stock price. But this also comes with great risk. The company's value can drop or even go bankrupt. And if that happens, your investment could be worth less or even nothing. Stocks generally offer high long-term returns, but they're much more volatile, so prices can swing widely based on market news, earnings, global events, and stuff like that. Bonds, by contrast, are usually seen as a more stable and predictable. They don't offer the same growth potential, but they do offer steady income and defined repayment schedule, which makes them a popular choice for more conservative investors that are choosing retirement. So if you want consistent money, you know the money, you want that money to come in every year or annually. Year or semi-annually, so every 6 months, then you go with the bond. Another big difference is what happens during a company's financial trouble. If a company goes bankrupt, bondholders are paid from shareholders. Bondholders are paid before shareholders. That makes bonds less risky in extreme situations. So if a company, since you're lending money, it's kind of like a bank. You have to pay off all your debts first. Then, whatever money's left, you start paying off the shareholders or whatever, right? Because the shareholders took that risk. So if you buy a bond, you might not get all of the money back, but you will get more money than the shareholder. Or, well, I guess you'll get the money first and then the shareholder will. So basically, as we can see right here, bonds are people who lend and it's more of an income and stability. On the other hand, stocks is an owner and it's growth and risk. And that's why many investors use bonds to balance their stock holdings so they can reduce volatility and generate reliable income, especially during uncertain markets. Kind of like we had when Trump was elected. It wasn't fully uncertain, but in a sense it was uncertain. We saw all those stocks crashing. So a lot of money was lost unless you shorted. But yeah. So why bonds matter? Well, bonds give you a predictable income and help preserve your capital. They're not flashy like stocks and they won't make you headlines. But that's exactly what makes them so valuable. They provide consistency, especially during times when the stock market is volatile or uncertain. When you invest in a bond, you typically know how much income you'll receive and when you'll receive it. This makes bonds especially attractive to retired people or anyone looking to generate steady cash flow without consistently worrying about market swings. But also beyond income, bonds also play a major role in risk management. Stocks can be exciting, but they can also crash. So bonds act as kind of like a cushion. When stocks are down, bonds often remain stable or even go up in value, especially high quality government bonds. This is because people are losing money on stocks and bonds are paying out more. So if you have low money, or so I guess let's say low interest, because let's say the stock market crashed, interest dropped, that bond, the interest doesn't change. That interest will stay the same for many years. So let's say the bond is this much amount at a 5% interest. Stock markets crash. Feds are trying to help out. Interests are down and interests are 4% right now. Well, your bond is 1% higher in interest. This makes it more valuable. See, you're making more money from your bond than a person would in a stock. And yeah. This is why many financial advisors also recommend a diversified portfolio that includes both stock and bond. Stock drive growth while bonds provide stability, income, and capital protection, and together they create a more balanced, kind of resilient investment strategy. So whether you're using You're investing for retirement, saving for a major goal, or just starting out, understanding and using bonds effectively can help you protect your wealth and grow it more steadily over time. Honestly, what's next? We're going to look at government bonds, corporate bonds, municipal bonds, and how to assess them safely. I kind of very, very lightly talked about it, but we're going to talk about the different bonds, especially government bonds and something called treasury bills. That's in the next video. This is a very, very quick what's a bond tutorial, and I'll see you in the next one. Thank you.